What are some of the most asked questions that buyers have about mortgages? We're going to talk about that today. First of all, most buyers will say, well, how much can I afford to borrow? And that's not a question that a realtor can answer for you. That's something that you have to talk to a lender about. So that's why most of the time when you reach out to a realtor, we're going to ask you, have you been pre-qualified? Have you been pre-approved? Have you talked to a lender? Because we can't tell you how much home you can buy. You could spout off your income, your debts, all that kind of stuff to us, but we are not the lender. So you need to talk to a mortgage person before you contact your realtor, or talk to your realtor to get a recommendation to a lender so that you can find out exactly how much you can borrow to purchase your home. What are the most common types of mortgages? And when it comes to mortgage types, it's almost like reciting the alphabet because all these different loan types go by letters. So you have FHA loans, which is the Federal Housing Administration. Those are oftentimes referred to as first-time homebuyer loans, even though you don't have to be a first-time homebuyer to use it. But an FHA loan only requires 3.5% down, so it is a government-backed loan. You have VA loans, which are the Veterans Administration. So if you are active or retired military, if you're in the National Guard, if you're in the Reserve, then you qualify for a VA loan. VA loans do 100% financing, meaning you don't have to make a down payment. Your down payment was the time that you served in our military. Thank you. On a VA loan, a lot of times they're going to have a little more lenient credit standard than other government programs. You also have USDA, Rural Development Loans. United States Department of Agriculture is what USDA stands for. And that particular program, again, is for mainly first-time home buyers. It's 100% loan, and it was to help people in lower income areas be able to get financed on a home without having to put a lot of money down out of pocket. You have fixed rate mortgages, which are oftentimes going to be called conventional mortgages through Fannie Mae and Freddie Mac. Those are typically going to require at least a 3% down payment, sometimes 5, 10, or even up to 20%, depending on what it is you're trying to buy. We do still have adjustable rate mortgages. A lot of people think that after 2008, adjustable rate mortgages went away, but they are still around. The lending practices behind ARMs are much different now than they were back then. But a lot of times if you go to a credit union to obtain a mortgage, you can get a 7/1 ARM at a better rate than you could get a 30-year fixed. And honestly, most people don't keep their mortgage or their house for more than 7 years. So if you do buy a house and you use this 7/1 ARM, and then at the end of 7 years, you're like, yeah, I really like my house, I don't feel like moving, then you can always renegotiate your loan with that credit union to either go into a fixed rate at that time or go into another 7-year adjustable rate. You also have jumbo loans, and we don't do a ton of jumbo loans around here, but the jumbo loan limit is if you're needing to borrow more than, I think it's $726,000, then you would be under the jumbo loan. So most homes in our area are going to be below that limit. Jumbo loans do have different interest rates than your standard 30-year conventional fixed. Another question that we get asked a lot is, well, what is the interest rate for a mortgage? And there's no flat answer to that. If you've watched videos that Kim Swan and I have done together, Kim's with Union Home Mortgage, there's so many factors that play a part in what your interest rate is. The loan type, the loan term, what your credit score is, how much of a down payment you're putting down. There's so many different factors that go into it. There's no way that if you call me and say, well, what's the interest rate, that I could tell you it's going to be 6.5 or it's going to be 6 or whatever. You have to talk to a mortgage lender to find out, based on your credit score, based on your financial situation, based on the program you need to use, this is what your interest rate would be. Another common question that I get is, what are the closing costs and the fees associated with getting a mortgage? And so closing costs are going to be things that you get charged because you took out a mortgage. That's going to include loan origination fees, underwriting fees, appraisal fee, your credit report fee. The title company is going to have fees for doing the title search, preparing the paperwork, doing the actual closing or the settlement of the home. You're going to have recording fees because the government always has to get their money. So when you buy or sell a house, you're going to have to pay this fee called a recording fee, and then what they call the state tax stamp. So there's all kinds of different closing costs, and they're going to be based on the purchase price of the house and the amount that you're borrowing. So again, I can't say, oh, well, your closing costs are going to be $5,000, because they may be more than that, they may be less than that. There's too many factors to play into it. Another question that I get is, what's the difference between being pre-qualified versus being pre-approved? And a pre-qualification basically means you picked up the phone, you talked to a loan officer, you told them about how much money you make, you told them kind of what your debts are, you think you have good credit. On a pre-qualification, they're really not worth the paper they're written on, because nobody has verified any of that information. A pre-qual just means you've spoke to a loan officer on the phone based on the information you provided to them. Yeah, it sounds like you should be able to qualify for a mortgage. A pre-approval is much more favorable, because a pre-approval means that the lender has actually verified the information that you provided. They've pulled your credit report. They know what your credit score is. They've looked at your income documentation. They've got all that calculated out, and that all works. You can get a mortgage based on that information. So when you've been pre-approved, it definitely puts you a step above other buyers who have just been pre-qualified, because now we know you can get a house. You just have to get the title work and the appraisal and all that kind of stuff done once you find a particular property. Now, as a realtor, yeah, we get asked mortgage questions all the time. I used to do mortgages before I got into real estate, so I probably can answer some questions better than maybe other agents in the area. But I'm normally going to refer you back to your lender, because things have changed since I got out of the mortgage industry, and mortgage rules and guidelines are always changing. So I will appreciate your questions. I will try to answer them for you if you ask me, but more than likely I'm going to refer you back to your loan officer, who is the authority when it comes to mortgages, interest rates, what programs you qualify for, and everything else. So if you're looking to buy a home and you need a referral to a great lender, let me know and I'll get you one.